Studio this time. Good morning, Francis. Thanks for coming in. So you're here to sit down for some FaceTime with your clients. What are you telling them right now about where we are in this cycle? Because oil market is definitely pricing in a clean resolution, world peace around the Strait of Hormuz. But that doesn't seem to be the case in terms of the inflation-related worries right now for inbound markets.
First of all, thank you very much for having me. Precisely what we have been talking about just now is also the key client concerns, be it in Singapore or even in Hong Kong over the last couple of days as I was speaking to the clients. The fact that actually inflation is a laggard indicator. The inflation that we are seeing being reported, the core PC, the PC that we have overnight, including the inflation numbers coming out from the US last week, they are reflecting what we saw in the month of May and of course earlier in the month of April and also in March, whereby the war drove energy prices up the roof in the world. But we are in the month of June right now, and we are supposed to be forward-looking. And if you look into if you dissect the inflation basket that for the US, in fact, you are seeing that the key reason for inflation moving higher in the month of March to May is mainly coming from transport. And why are transport prices going higher? Is it because the cost of second-hand cars are higher? It's not really the case. It's because of, at the pumps, energy prices, gasoline prices. If you look separately at the retail sales numbers in the US, we may think that retail sales is pretty robust or strong. It came mainly from the gasoline stations again, right? So what that means is that I believe this is only going to be temporary. And in fact, the industrious house view is that by the second half of this year, which we are very close to, we are going to see inflation not being a bigger problem for the US. And that is going to pulse the Fed further thinking about any rate hike, which I think the market is wrongly pricing in right now. Okay. So this is the key concern by clients. They are so afraid that, if the Fed is going to hike rates due to the higher inflation that's so sticky, then growth stocks, tech stocks may see a further sell-off. I'm telling them that is not true.
Okay, so what is the Fed's next move and when do you see the Fed moving? Because a lot of digestion around Kevin Warsh is being done right now. People thought he was hawkish. I mean, people as in like the consensus seems to be that was the immediate reaction in the bond market. You don't agree with that?
I don't particularly agree with that. At the end of the day, it's really to be data dependent, right? But data dependent, the cup can be half full, half empty. A lot of times we shouldn't see numbers at the headline, but continue the use of dissecting the numbers into its final segments and also to look out for alternative data sets. By alternative data set, one of them is the Visa Spending Momentum Index. That is a great index that separates the consumer goods and services that Americans use the Visa card on into discretionary and non-discretionary. If we are seeing the American economy being so really robust, then we are supposed to see perhaps discretionary spending on the rise higher than non-discretionary, but we are not seeing that the case right now. So while the American economy is robust, the K-shaped economy or the K-shaped recovery is very evident. Those in the key sectors of AI, tech, semiconductors are benefiting immensely, but the rest of the economy, only a part of them are benefiting from the World Cup, but the rest of the economy, I believe, is going to see a further slowdown. So that should not prompt a rate hike that the market is pricing in. Industrious house view again, the big change over this month in our latest Global Investment Committee is that we initially thought in the second half of this year we may see a rate cut by 25 basis points. But because of the situation that the short-term inflation driven by energy prices could still be there for a while more, we are pushing that forward further down the road into 2027, a Fed rate cut.
You might be comfortable with that idea of rate cut being off the table. But if the rest of the market reads Kevin Warsh as hawkish, do you see a lot of volatility in the second half? Because we've got Fed digest, as I said, midterm elections, and how does that lead us to your investment thesis as well?
Sherry, this year will be a conflation of many things together. Yeah. What you mentioned just now, and I'm going to add more to the volatility. One of the rising and trending risk, people are calling it the black swan. I don't think so because it's slowly being discovered. It could be a gray swan.
Many gray swans.
Exactly, many gray swans, right? And one of the big ones is this El Nino effect, which I believe we have been slowly reading more about. And it's not going to last 1 or 2 months. It's going to last like almost the entire full year. And the El Nino effect is going to bring rain to places that don't need so much rain, and it's going to bring drought to places that need more rain. So the entire Godzilla level of El Nino effect is going to perhaps push global food prices on the way higher. The latest numbers from the FAO, the Food and Agriculture Organization, already shows food prices, although it's a lagging indicator, on the rise on a year-on-year basis compared to last year. Now, will this El Nino or Godzilla El Nino effect push food prices even more higher? And especially emerging markets that really depend on agriculture, fishery, as a larger percentage of their global or total GDP, I think this will be something that we should be looking out for, and that could cause even more volatility in what Fed is going to do as well.
JP, come in on this.
Yeah, and touching on that El Nino effect there, Francis, because it is the talk of many agricultural sectors in Southeast Asia as well. And given that food security is such a big thing coming off of the Iran war, which, by the way, we're not sure we're completely out of the woods yet on, again, could that actually prompt policy action from central bankers across Asia as well to address some of the possible inflationary risks there, and thus also perhaps alter any strategy when you're looking at fixed income and markets on this side of the world?
Hi, JP. That is, again, certainly one of the key questions that my clients are asking. We have just seen over the last couple of months one wave of inflation coming from global higher energy oil prices. And that prompted many emerging economies in Asia over here, particularly in the Philippines, in Indonesia, even in Japan, a developed market that relies on energy imports as a percentage of their total domestic energy consumption. That continues to see them having a depreciating currency because the markets expect that the government may come in a bigger way to subsidize energy prices, to satisfy the population, but kicking the can down the road in terms of higher fiscal deficits. So that's why currencies in these markets went down, bond yields went up. Now, since then, the stress of a potential second half food inflation may continue to see emerging markets, central banks, being on a heightened mode of watch out and watching out whether they may even have to hike rates further. So we have already seen Philippines, Indonesia, even Singapore tightening their monetary policy. I probably don't believe that that is the end, and there could be even some more room for tightening going ahead, especially if this grey swan of the Godzilla El Nino is going to come up in a bigger way in the second half of this year.
And since you brought up Japan, I do wonder what this will mean for policy action there, because as we've seen, there are food prices there and energy prices starting to rise in Japan. But as we've seen also from the history of Japan, they are actually hoping for more of this price action, perhaps inflation coming in that could support a rate hike from the Bank of Japan. Because of how weak the yen is, because of the fact we're seeing inflation starting to come in a bit more, does that then bolster the case for even more tight policy from the Bank of Japan, and thus could also mean certain effects on commodity, on asset classes like currencies, the Japanese yen, and even that of fixed income out of Tokyo?
Right, JP, the good news for Japan is that while they are very reliant on importing energy from the rest of the world for their domestic consumption, they are a little bit more self-sufficient comparatively in terms of food. Quite a lot of the foodstuff are currently still being produced onshore in Japan. However, I do still believe, industrialist view is that the Japanese the BOJ will still have to have a rate hikes going forward. I know the 1% right now that we're seeing is the highest since 1995, but I believe it will be perhaps more important for them. If you look at the yen right now, 161, it risks going towards 165 to the dollar. I believe the rate hike will be on the cards coming up as well.
Francis, perhaps you could chime in on some of the quizzical moves that Sherry and I have noticed in the currency space. Earlier on, we were talking to Ajay Rajayasta from Barclays about the conundrum of the won weakening despite all the strength and exports and inflows coming to South Korea and in Japan. While it seems to be on a hawkish tilt, it seems that nobody is buying that, and it seems that the bears on the yen bears continue to roar through the forests. What do you make of all this quizzical weakness in these currencies? Are they perhaps being oversold at the moment? And what do you think might be driving some of this weakness that's been a little more difficult to pinpoint, especially for these two particular currencies?
Yeah, that's right, JP. I was watching the interview just now, Sherry, Ajay, and yourself, talking about the conundrum behind the Korean won. First of all, Korea is selling a lot to the rest of the world, very much tied into the semis and the AI trade. but yet the current account is having amazing surpluses, but yet the Korean won is depreciating. Now recall back in Economics 101, the balance of payment of a nation is equivalent to the current account and the capital account. So if the current account, although it can be strong and be having a strong surplus, the capital account in Korea is what we are seeing it being more negative, more than the current account. So that means that funds are in fact flowing out of Korea to the rest of the world. Now, some of the things can be like the following. If you are, imagine you're an average Korean household, you buy your own Korean stocks, stock prices go up in quite a big way to some of the names of the stocks, but yet the diversification, the portfolio allocation entails you perhaps even to sell off some and to deploy that in a diversified geography, not in Korea. So perhaps some of these, including what fund managers are doing in terms of their diversification strategy, because we keep hearing about concentration risk, even in Asia, in the stock indices, looking at how the two big companies in the Kospi is. So I guess there's some portfolio reallocation that causes this capital outflow to have some depreciating pressure in the Korean won. Similar in Japan as well.
Francis, it's great to have you joining us. Thank you so much for coming in this morning. That was Francis Tan from Indo-Suez Wealth Management. Squawk is going for a quick break. We are back in 2.